Well, there you have it. The closing bell at the New York Stock Exchange ending another day of trading. The Dow Jones started the day up, but saw a sharp drop off at 2 p.m. The Federal Reserve made its announcement that we were all anticipating. It is raising interest rates by 75 basis points. The numbers were down in 2 hours of trading that followed, eventually ending down, it looks like, over 500 points.
Wow. And the S&P 500 and NASDAQ effectively mirrored those movements of the Dow Jones, ending the day around 1.5% lower. We're going to bring in Liz Young now. She's the head of investment strategy at SoFi, a personal finance company. Liz, we know that the Fed announcement, a major driver of market sentiment today, with that drop off at 2 p.m. and then things seemed to come back and then those gains reversed. We understood that investors had already factored in this interest rate hike. They knew this was going to happen, and it happened as expected. So what do you make of where the market ended today?
Well, you're right that investors anticipated the 75 basis point hike, but I don't think that was the market moving event. The market moving event was actually the projections that the Fed put out, particularly around where they expect the Fed funds rate to be at the end of this year and where they expect it to be at the end of next year. Both of those projections went up markedly from what we heard from them in June. So the market had to adjust based on that fact. However, what happened when Jerome Powell started talking was we saw a lot of whipsaw. So the market came down initially after the hike, and after we got that information of the projections, then Jerome Powell started talking and said, I am committed to getting inflation under control. The market seemed to like that. And then later in the day decided, okay, but you know what? We still haven't solved the problem. We're still headed for rate hikes, and we're still afraid of a recession. So I think that's where we ended the day.
Yeah, we saw a lot of sell-off, a lot of selling off right at the end there. As we're talking about Jerome Powell's remarks, I want to share a little bit of that, what he had to say, because it was really a similar message to what we've heard from him in recent weeks, particularly regarding inflation.
Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done.
So softening labor market conditions, that strikes most analysts as layoffs ahead and other negative things in our economy. How do you interpret it?
I interpret it as the Fed is willing to withstand some pain in the economy. And I think what's difficult to digest, especially for the market, is that the Fed has that dual mandate. They're responsible for price stability and maximum employment. So it does feel a little contradictory to hear them say that they're willing to withstand weakness in the labor market in order to get inflation down closer to their target. Now, I think that there's a decent possibility that they become satisfied with inflation close to the target, but maybe not all the way down to 2%, because we've got a long way to go. If we're at 6.3% PCE and 8.3% CPI, getting back down to 2% is going to take a while, and it's going to take a lot of force. So I think they may have to adjust that and be a little bit more flexible with the target as time goes on. But he's right. There probably is pain to come. It's just a matter of how deep that pain is going to be and how many sectors in the economy it will affect.
And the raising of interest rates isn't the only, or what I should say is, raising interest rates won't keep inflation at bay, since there are global factors at play, the supply chain, China, war in Ukraine, energy as well. So in your view, will today's rate hike, can it really be the last straw to break inflation's back? It sounds like not so much.
No, well, so we've talked about this a lot. People like me have talked about this a lot, where the Fed can really only affect the demand side of inflation, meaning it can lower demand in order to try to bring prices down and bring that supply-demand dynamic back into balance. What they can't affect is the supply side, and they can't really directly affect the US dollar as well. So what's happening right now is we've got the rest of the globe really in a lot of pain. Europe is suffering quite a bit. Asia is certainly not out of the woods. So you're seeing strength in the US dollar, which is going to put pressure on our exports, and that makes it even more difficult. It also makes it more difficult when we have the strongest economy, because our demand is stronger than other economies. It makes it more difficult to affect that demand to a level where it brings inflation down to a more comfortable percent.
Yeah, when your strengths are your weaknesses, it's hard to really complain about the road ahead. But we'll see what happens next. Liz Young, thanks so much for joining us.
Thank you.